Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So today I'm asking the question, where is the money going? Because I'm really struggling to figure this out, and my spider senses are tingling and I can't figure out why. And so we're going to walk through that. So I want to go through the current market, and I want to talk about some of the recession data starting to spike up and why doesn't the stock market care. And so I've got a whole bunch of things, and I'm not looking for problems. I was trying to find solutions, and the problem is it just keeps getting more and more difficult to envision this market continuing to go higher as the data literally starts to crumble behind us. So that's what I'm thinking about. So today's show will present a lot of different views coming in. If you think my views are wrong, I don't have any trouble with that. What I think more importantly is just understand the macro backdrop here, and if the macro backdrop can magically take off to the upside, great. I'm not seeing that in the data, and so that's the real problem. Okay, if you have any more questions, you could always head over to Osprey Strategic and try out our trial offer for just $7. Again, the market is very difficult here, so you can go to one place one week and one place the next week and get two different opinions. It's a really difficult market, and I'll explain a little bit of that for you. But let's jump into the charts and go forward here. So one of the first things that we could go through is some recessionary charts, but I'm going to talk about today, right now, where we're at on this one chart. And this chart, I track it in the background. I flip past it every time. But one of the things that just showed up on Friday was that we got 98% on the percentage of the stocks rising on their PMO. So on their momentum indicator, whether it's a MACD, a PPO, a PMO, a KST, when that turns up, that's a good thing. When everybody's turned up, that can mark some problems. And one of the things we found since the bear market started, so in October, we had a little bit, this made it only to 87, but continued to run up after that. But once the bear market started, so after November is when the NASDAQ topped, and in late December is when this indicator topped, and then early January 4th, the S&P topped. So when this indicator spikes above 85 or 90, you can pick your number, it's a pretty important place to watch for. And then we have had some meaningful downtrends. Now, if we're starting a new bull market, which, man, there's a lot of that going on, then this market can continue higher, and we're going to just be in a beautiful place. So anyway, what happened in March of 2022 was we literally, everything looked great. We broke the downtrend, we broke the prior high, and we took off to the upside. And then we literally went on a 2-month straight down move and wiped out any gain that might have been in there, and literally went really down hard. Now we spiked up on this move as we came out of this low. We had made a higher low or a higher high, and then we fell again. And so then we got back up to the prior peak. Sure enough, we had a bunch of little readings up here. Again, I'll call it 87, 88. We made it up to 94, and that marked the top. So then we got to 97 on the spike after the October low, and we pulled back. Now, this was only a pullback for a week or so it didn't look too severe. But then we really haven't had anything in here for 6 months, and all of a sudden this thing has spiked to a massive level. Now, many people are saying the new bull market is starting and we're on our way and that kind of thing. Here's the problem I have is the economic data is getting consistently weaker, and the money flows changing dramatically right here. But all of a sudden, we're really bullish on stocks, and I've got some charts to follow this up. So it makes me ask the question, okay, great, we should be seeing huge surges into the equities market, and it should be coming from somewhere, bonds, something, but it's doing exactly the opposite. So here's a chart from Kurang Patel. The source is Exante data. But here's the top 10 weekly ETF flows to Monday, April 3rd. And what you see is it's flowing out of the SPY, it's flowing into the bonds. Like, there's just not a lot that makes common sense here for the market to keep going higher, but the money's leaving. And so here's the S&P 500, here's the iShares S&P ETF, here's the weekly Treasury bond, boom. Without even looking at the headers, when you start to read the headers now, it goes, wow, yeah, this is the Russell 2000 money leaving, the TIPS ETF money leaving. Here's QQQ, it's still got some flow. Now I'll show you the next chart. Momentum of ETF flows by sector, and what we're seeing is large cap has actually switched to a 5-day sum of flows of negative. So again, this is for Monday. And then the 20-day sum of flows into treasuries is way up here. It's continuing every day to be higher and higher. On the monthly conference call I did with clients yesterday, one of the questions was I got, is it still safe to buy bonds? And they're looking to just protect themselves. And my uncomfortableness here is the money's flowing away from the equity market, but the equity market continues to go up. Now, maybe that's no big deal. Okay, so it must be that the data is improving behind the scenes, and we'll get into that in a second. But let me just show you one more thing from Twitter. And this is from a guy called Strip Mall Guy. And he's got, this was a tweet yesterday, so commercial office market value, $3 trillion. Well, rents are down 25% at a minimum, and that's because nobody's in the buildings. Cap rates are up, so that's your interest rate change, 200 basis points minimum. Translation, 1.5 trillion value wiped away. From 3 trillion, we're wiping out 50% of the value in commercial office REITs, or commercial offices. So what happens next? So the data's awful, and yet the market continues to rally. So maybe I'm just looking too hard for problems, but I thought this was just a great one because I've been accused of being too negative sometimes, but I can't think of anything in business more expensive than fear of missing out. Betting just to bet, getting in because everyone is. The opposite is how you make money. Study something, save up, wait, keep waiting, keep studying, then bet big when the opportunity becomes crystal clear. So I'm sitting here looking at this data fold in front of me, literally commercial real estate with a 50% sale sign on it, and everybody still wants to hold the market up. Real estate was one of the best sectors last week. And so, so I'm looking at Bitcoin. Why is Bitcoin just kind of idling along here for the last 3 weeks if we're in such a new bull market for risk on? And so I've got a trend line here for relative strength. And as long as it doesn't break, I'm still going to say Bitcoin's still going higher. But there's a really defined channel here. And we're starting to leave the top of the channel. So now at least let's watch to see what happens. And I could put a dotted line obviously up the middle. But it makes me at least just think differently about what's perhaps going on. Okay, so now I want to cover off, so again, I probably sleep differently than most people, but I woke up this morning. This is the 10-minute chart of the S&P 500, and the white charts is when the stock market's open, and then this is the post-market and pre-market. And so we're working our way up, and we've got a nice trend over the last 3 days or whatever, and a 3-day trend doesn't matter. My main point here is just the market continues to work its way higher, 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 and as long as it does that, we're cool. And I I'm not trying to predict when the market will collapse. I'm just asking the question, if money's leaving, why is this still going higher? And so, again, that 5-day rate of change was showing everything going to treasuries, money coming out of large caps, and here's the large cap indicator going higher. So that doesn't match with what I see. So I created this chart, and I've put some labels on it. So you had the huge move up 2020 to 2022, and then you pulled down in a big 5-wave pattern. And then you make your low, and then you have a 1, 2, 3, 4, 5, 6, 7 bounce and fail. And so now the expectation based on this pattern should be that we go lower, not higher. Now, there's two different interpretations of the pattern. So the other one says we break higher from here. I'm going to show you a really interesting little article. So here we are. This is from a website called Traders Day Trading, and it's got some Elliott Wave stuff going on. But this is a gentleman from the 60s and 70s who published a newsletter. His name was George Lindsay, and he created the 3 peaks in a dome house concept. So basically the market runs up and then chops around and then pulls back and then runs up, chops around, takes off to the upside, makes a topping pattern, and then crashes. So the problem for me was this doesn't really fit anything we're in because we've already had this big move down. So then I scroll down the article a little longer. And again, history in the stock market is about seeing a pattern you've seen before. And so it's this 3 chop pattern that is kicking me off. But one of the things they said, George Lindsay also identified a very little known variation of his original pattern where the domed house pattern formed first and was then followed by the 3 peaks part. And so you have the 7-wave move down, and then you have this move up, and it's wave 7 right here that you want to be careful of. Then you have an 8, 9, 10. Now he's labeled this as 0.1. I'm trying to figure out why he didn't label this one. So I've labeled this one 1, 2, 3, 4, 5, 6, 7, 8, 9, and you're starting at 0. So when we go back to my chart, this is the way that looks to me. So 1, 2, 3, 4, 5, and then 1, 2, 3, 4, 5, 6, 7. And now the question is, do we shoot higher from here or shoot lower? I don't know. And the right answer is nobody really knows. But I know the money's leaving, and I can't help but notice this article comes up just as I'm thinking that. Why are we betting just to bet getting in because everyone is? Study something, save up. Okay, so let me do a little bit of study. So again, here's my Fed chart, and this momentum change percentage oscillator says how fast is the momentum for what we're seeing. And so one of the things that we need to at least be aware of is that the Fed move from last year to this year is the fastest on this chart, going back to 1980. Maybe there's periods before it. But the real question is, we've never seen a rate of change so high ever. And again, even if you started it at 1% rather than 0.25%, it would have still been a 400% rate of change in 1 year. And that would be more than double anything we've ever seen before. So why do we think this is going to work out really, really well when the Fed is absolutely super spiking rates, trying to stall the economy on purpose to get inflation down? And again, this to me looks like one end has come loose on a axle or whatever, and it just starts to wobble the farther away you get. And the wobble literally in 1 year went for the lowest low well over the highest high. This took 8 years to do. Even this quick move in 04 to 06 was a 2-year move. And guess what happened there? We had the GFC and the real estate crisis. So when I look at these things and I go, okay, so why doesn't this chart matter yet? So here's another one. So now we're going to go through a few of the charts in my recession watch list and just say, where are we at? And so when you look back here in 07, again, this is after the Fed made a huge move up in interest rates, stalled the housing market, and the interest rates rolled over, and we had this big drop in industrial production. Now, it ended up being that it was the banking that caused the problem, but the first bank failure was here. We've already had 3 bank failures, and industrial production had rolled over at the end of December in 2007. So we're taking our time rolling over, right? Stock market topped a year ago, and now we've rolled over. So we did it in 2018. We rolled over, and in 2019, this was declining. The Fed was starting to allow things to improve in 2019, and then COVID hit, and obviously that created a bigger dilemma. This was the price change in oil back in 2014. We saw a huge shift. Oil literally dropped as there was no OPEC support. They basically said, fine, we'll let the price bottom out and we'll get rid of all the other producers. So we saw big changes in 2014, and we actually fell all the way down into the bottom of 2016 for a stock market. So this industrial production takes a lot to roll this thing over. But we just came out with the PMI data yesterday that was at COVID lows. So we're at 46. We were expecting 47. This thing's literally coming in so light. So that's one piece of data. Agreed, one piece is not everything. So let's go look at housing, single family housing. So this is wobbling along at roughly half the rate it was at before. So this is homes sold, new single family homes. And everybody's going, well, it's fine. It's turned up and we're good. Well, literally, we're so far below the 40-week moving average, or I've got this as the 30-month moving average. We still have interest rates rising. There's nothing saying that this thing is probably going to, go vertical after, with the hardest part of the road ahead, high interest payments. And I just saw an article yesterday from somebody who's in the car business, and he's just saying the number of new cars going out with payments over $1,000 is just exploding higher than anything we've ever seen before, and yet everybody's comfortable with this. To me, it just makes the car business that much harder to want to own. If everybody is struggling, we're starting to see credit card debt head up. So you've got this huge market situation here where single family housing sold is less, or about half of where it was, still declining for the most part. Yes, it's rattling around, but still declining. So until we see a meaningful move back above this 30-month moving average, I would just say I'm probably in the camp that things could get worse on the housing front. So now we go to housing starts, and housing starts is below its 30-month moving average. And again, look at this chart. This is comparing it to the Fed funds rate back here. And every time this thing accelerates, it causes a drop in the housing starts. So we're just barely below this line. We were up 14% in housing starts on the last reading. Okay. And again, nothing goes straight up or straight down. But the real question would be, with this kind of a rate of change move in the Fed, and this is what happened in 04, 06. Here's what housing starts did. And once they actually started to fall apart, it was meaningful. So we've ticked up, and some people think, no problem, everything's fine. Well, just take my PPO momentum indicator, and when it goes negative, do you want to own this housing starts or not? And to me, no. So you can compare this on the recording, just take some time with it. But basically, it tells you all the ugly periods in the housing market. And we're behaving like everything's just fine there. So the housing stocks are still hitting fresh new highs. So I showed you industrial production. Here's your banking watch. So this is our 10-year trend line on banking from 09 to 2022. We broke it in January 22. We're coming down. Let's just ignore COVID because it was a weird situation, but whatever. Even without COVID, we would be going back to 2017 to have prices this low on the banks. And so you've wiped out 6 years of stock market gains on the bank, and we think everything's fine because for a few weeks we haven't fallen harder. This is a 10-year, 12-year trend line. It's not something I just want to ignore, that all of a sudden banks are breaking to new lows. So then we have some other charts, and this is the yield curve. And so one of the Fed's spoken choices is they like the 10-year versus the 3-month. Okay, well, this goes back to 1980, and it's at the absolute worst reading ever in that time frame, so 50 years or 45 years. So you're looking at this huge breakout to the upside, and what could possibly go wrong? This thing is telling us major issues. And then here it is in 2000 where the stock market rolled it over. Here's 06, 07 where it rolled over. 2020, obviously, again, that was COVID effect. So I always want to clarify that. Even in 1990, this thing topped out, and then you went on 2 years, and some people will say, well, we already have had the year-long pullback. Here's the problem. This thing's still going higher. We haven't even started the rollover, and the rollover's when you really have problems. So when I look across all my charts, I feel like I'm living on Strip Mall Guy's tweet here. Are we betting just to bet, just to get in? Study something, save up. So when I'm seeing the macro literally degrade in front of me, I can't help but be more concerned than less concerned that the right thing to do is keep adding money at these trades. And I get it. You might find a chart that works for another week, month, whatever. Go ahead. But the problem is, like even University of Michigan sentiment, when this thing's below this 70 level, this is 08, 09, and we've just turned back down on this sentiment indicator, saying things are worse, and we're below zero. So we're, that just added on to the list of charts. And unemployment claims, now this is shown inverted, but what you see here is I've flipped the chart upside down. So we made our lows in unemployment, and I'm going to just talk about it now normally. So we made the highs in employment. We made a lower low, a lower high, a lower low, a lower high in employment. And if we start to go below this green moving average, and this is 65-week moving average, so 6 quarters. If we start to fall back below, then still want to be cautious. Now look at what my PPO is doing. It's giving us the sell signal again, and we've had a wild, rocky start here with COVID and all that kind of stuff. So maybe this chart isn't the right context, but I would just say we're starting to see the unemployment claims change. And again, if I inverted the chart, it means they're starting to rise. And we've had one spike through the green line. Now, will we get another one? I don't know. But it just, everything is lining up here like we're at the edge of something big. And again, I go back to the Fed chart. But when I look at this, this chart right here and this rare pattern that George Lindsay had way back then, and we're sitting right here at point number 7. Now, maybe point 7 goes all the way up here, but at least make sure your portfolio is protected, because, we're starting to see some massive changes happen. And again, they don't all show up on the same day, but these things are piling up, and it makes me way more concerned that being in the market, the one thing you will notice is it basically shows some big spikes down after this point. So if I'm right, and again, it's not about being right, it's about trying to see what's going on in the market. To me, the fund flows are leaving the market. The Fed is trying to stall the economy. The economy is stalling. Real estate's in half, housing markets are slowing, car payments are getting too high, credit card debt is soaring. Unemployment is picking up, and yet the stock market wants to go higher. So with all of that, I'm trying not to be, again, I'm trying to find why the market's going higher, and I'm getting the opposite result. So I would really encourage you to take some time and figure out how it works for you, or how you think this all works out. And just, again, whatever, some charts breaking out, some semiconductor stocks still doing fine. I get it. Go ahead and try and follow those. But I think once the market decides that this is really a bigger risk off moment, that the speed of decline will be surprisingly difficult, because they'll recognize that the Fed actually did what they said they were going to do, and that is reverse the economy. So all pessimism aside, I can be wrong. I'm comfortable being wrong. What I'm not comfortable being is losing money. And again, going back to the strip mall guy, are you betting just because somebody else is getting in? And I had a good friend of mine. He was looking to buy some commercial real estate recently, and I just said to him, like, have you even absorbed what's going on around you? And then so I shared some charts with him, and he just said, we're not going to do the last deal. And I'm thinking, yeah, that's what happens, is all of a sudden we all kind of get the data and then we just stop doing the last deal. So with that, I'm going to leave it. I want you to just make sure you protect your capital. So thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern Time. You can also see the recording on StockCharts TV YouTube page. Thanks, everybody. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.